Mergers and acquisitions have been heating up recently, and although the correlation isn't perfect, mergers and acquisitions do tend to peak prior to a recession. Now, this makes a little bit of intuitive sense considering the reason why a merger or an acquisition would take place. You've got tons of cash from the recent money printing, you're looking for a higher ROI on your money, things are starting to slow down in your current business, so you're looking to other markets to expand into, or you crunch the numbers and you find it's unprofitable to invest in your own business and build something from scratch, so might as well buy it from somebody who's already built it. Now, the key thing here is that these tend to be cyclical, especially within sectors and industries. Especially short term, the money is made buying the companies that end up getting acquired later. Recognizing these patterns can pay off big for investors who time the cycles correctly. Ready? Let's dive in. 2020, as you might imagine, was a very slow year for mergers and acquisitions. In fact, it was the slowest year since 2014. But things are heating back up again, and we recently just got a potential for a new record in M&A. Microsoft announced a deal to acquire Activision Blizzard for a mind-boggling $69 billion. Now, if this goes through, it will beat out the previous record from Dell when they acquired EMC for $67 billion. Now, like I said, this is not a done deal yet. It still has to go through approval by Uncle Sam to make sure it doesn't look like too much of a monopoly here. It then also has to be approved by Activision shareholders. But take a look at something interesting here. We're looking at the Activision chart. You can see that shares shot up about 32% overnight and are currently still up about 20% from where they were before. So why is this? Well, the shares have to adjust higher to get much closer to what that offer price is. Because if I know there's a chance that somebody else is going to be buying the shares at $80 or $85 per share and they're currently trading at $65, I'm going to buy as many of them as I can until it gets a lot closer to that $80 or that $85 mark. So this begs the question, why would Microsoft offer so much for Activision? Well, if you're gonna try and buy an entire company, you can't just offer the current price. First of all, shareholders would have no incentive to sell you the shares at the current price. So you have to make an attractive offer. Second, the buying out company can't just go onto the open market and start buying up the shares at the current market price. There's just not enough liquidity for that, and the shares would in the end up spiking and skyrocketing a lot higher, and the company that's doing the buying, in this case Microsoft, would just not get a good deal. So they make a reasonable offer above the current market price and hope the shareholders agree. Now, this deal is making headlines. It's a big one, but it's not the only one. Sony recently announced a deal to buy Bungie, the maker of the video game Destiny. Blackstone and Carlyle are looking at buying a pharmaceutical company called Novartis. SeaWorld is allegedly making a $3.4 billion offer to buy the amusement park company Cedar Fair. And some analysts are now saying Apple needs to start hoarding all of this useless cash and make an acquisition, which they might have a valid point about. Apple has so much cash on hand, if they wanted to, they could literally buy the entire company Disney. They could buy Netflix. They could buy T-Mobile. There's so many ways they could put the cash to work. It's just a matter of finding a company that aligns with their interests, like they did with Beats a few years back. Now, all this news of mergers and acquisitions is somewhat interesting to me, considering the track record of mergers and acquisitions. It really doesn't have the best track record. An older but thorough study found that stockholders of acquiring firms suffered a loss of about 10% over the 5-year post-merger period. So why is this? Well, when it comes to organisms and organizations, bigger is not better, bigger is badder. You've got centralization, you've got duplication of roles, you've got additional fat and bloat, you've got a larger organization now, larger separation between the leadership and everybody else in the company, and many other problems that come up post-merger. Basically, at least short term, the winners from an acquisition are the people, the investors who bought the company that's getting acquired beforehand and are able to sell when it's bought out by the company that's doing the acquiring. But that brings up the question, how do you buy a stock in anticipation option of it getting sold to another larger company later on. Well, obviously you can't know for sure if a company will ever be acquired. However, there are many businesses that build and grow for that specific purpose only. They just want to become as attractive as possible to a potential buyer, which is a perfect segue to talk about STRPF mining. STRPF is sponsoring this video, so a big thank you for supporting the channel. And by the way, speaking of supporting the channel, I never mention subscribing or liking, notifications, anything like that in my videos, but YouTube recently informed me that they are going to be purging a lot of the scam and the bot accounts, which, by the way, I'm so thankful for because those things are so annoying in the comments. But I've heard from a lot of you that you might have gotten kind of swept into that and been unsubscribed, or that your notifications are no longer working. So just a friendly reminder, if you are subscribed or want to be subscribed, and if you think you have notifications turned on, you might want to just go double check because it might have gotten shut off for you. Okay, back to STRPF mining. Full disclosure, I am a shareholder of STRPF mining. You know, I've got a portfolio with many different mining companies, so I do have a small position in STRPF mining. And this is not financial advice or an investment recommendation. But STRPF mining is a company that has been doing exactly what I described earlier. It has set up its entire operations to be as attractive as possible to potential buyers like Barrick or Goldcorp or Rio Tinto. So why exactly would a junior explorer like STRPF be a candidate for an acquisition? Number one, drill success. In their drilling, they're hitting about 9 out of every 10 holes. Now, that's very good. A 90% success rate in finding mineralization is almost unheard of. So what is it exactly that they found? Well, number one, they found zinc. But not only zinc, they've also found copper. But not only copper, they've also found silver. And not only silver, yeah, but wait, there's more. They've also found gold. No joke. This is something called a VMS deposit. There are only 350 VMS deposits that have ever been found in Canada. Yet, even though they're so rare, they produce a vast majority of the metals. They account for the production of over a quarter of copper, 27%, almost half of zinc, 49%, and 40% of silver. This is because most VMS deposits are very large and they have long lives, so large producers like to pick up these assets to add them to their portfolio. So are these drill results just a fluke, or is there anything else that we can look to that might be a little bit more predictive of future success? Well, take a look at this map. This property is located in Quebec, which is one of the most mining-friendly jurisdictions in the world. Right next door to this property is an old mine called Normetal. This mine is a past producing mine that STRPF also owns. And if we look to the other side, this is where the news gets really exciting. We see yet another mine. This one's called the Perron property, and it's owned by Amex Exploration. Now, due to the gold that Amex has discovered there, they've raised a ton of cash, and their share price is up about 4,400% in just the last couple of years. Keep in mind, this deposit is right next door, and it only has gold. STRPF has a VMS deposit, which in addition to gold, has silver and copper and zinc. Amex has drilled 300,000 meters. STRPF has only drilled 90,000. So the major point here is that right next door, another company has experienced massive success with a potentially inferior asset, which means the upside for STRPF could be way more. Now, with all this good news, you would expect the big boys to be getting in already, and that is exactly what we find. First of all, the company has 38% ownership by management and insiders. Very good. Second, institutional ownership is 40%. That leaves a very tight float, just over 20%. In addition to insider and institutional ownership, we also see talent coming over from Amex right next door. And not just any talent. The founder of Amex, Dr. Jacques Trottier, recently joined STRPF as their chief technical advisor. So in summary, investors of companies that end up later getting bought out by larger fish are the ones who get the big paydays. It's very difficult to nail the timing on these, but as gold and silver enter a new bull market, it's very likely we see a new cycle of mergers and acquisitions begin in the mining industry, just like we're seeing all over tech right now. while. As with anything, risk management is key. Don't invest more than you can lose, and you can lose everything. As with any investment, it can go to zero. And if you're leveraged, you can lose more than you invested. None of this is an investment recommendation or financial advice. I'm just some guy on the internet trying to help people understand how money works. As always, I really appreciate you guys. Thanks so much for watching. Have a great day.